Alarming signals from the Federal Reserve's January meeting. Recent minutes from the Federal Reserve's January meeting revealed crucial information that could impact every American. While the financial media downplayed this revelation, the Fed signaled a potential shift in interest rates, contradicting the widely held expectation that rates would decrease. Contrary to the narrative that rates were set to fall, several officials discussed raising rates if inflation remains above the 2% target. This conversation indicates a significant concern about the economy's stability. After a series of rate cuts in late 2025, many anticipated a continued downward trend in rates to make borrowing more affordable. Instead, the Fed voted to hold rates steady at 3.50% to 3.75% in January, raising red flags across financial markets. Economically, the U.S. is exhibiting conflicting signals. While employment data appears robust, with unemployment dropping to 4.3%, inflation stubbornly persists, with core consumer prices at 2.5%. Many analysts now fear inflation could rise again, contradicting hopes for lower rates. The ramifications of higher interest rates are dire. Currently, Americans face nearly $12.6 trillion in mortgage debt. If rates rise, mortgage costs could exceed 7%, drastically increasing monthly payments. This situation would make housing less affordable, significantly impacting families across the nation. The burden extends to credit card and auto loan debt as well, both of which exceed $1 trillion. Higher rates would increase interest charges, further stressing household budgets. Additionally, rising delinquency rates indicate that many consumers are already stretched thin, unable to manage additional financial burdens. Politically, the widening disconnect between the White House's demand for lower rates and the Fed's discussions presents a risk to financial stability. The Fed is designed to operate independently, a crucial factor for maintaining confidence in the U.S. dollar and avoiding inflationary spirals seen in other nations. As the Fed grapples with how to respond to persistent inflation, every option carries significant risks. Cutting rates could reignite inflation, while holding them steady continues to pressure consumers and businesses. Raising rates might trigger a severe recession, impacting employment and economic growth. The economic landscape has never been more uncertain. The Fed's language in its January minutes indicates serious considerations of rate hikes, setting the stage for potential market volatility. Investors and consumers alike must brace for the possibility that the financial relief many expected could be delayed or entirely absent. In conclusion, the Fed's communication highlights an evolving economic landscape requiring close attention. The potential for financial outcomes that differ sharply from current expectations is significant. Those willing to prepare for these changes will be better positioned to navigate the uncertainties ahead.